Go ahead and get started. I want to thank everybody for taking some time to come with us and come meet with us here and share lunch with us and everything. And really what we just thought we'd do is we've been getting calls and comments and questions about the market, particularly the volatility recently and what's going on, what caused this, what's happening, why, so forth, where we're going. So we just thought we'd share a few ideas with you and kind of put all this in perspective. So why don't we just go ahead and get rolling, Amber. First thing we'll do, this is just kind of the obvious. This is a chart of the S&P 500. We pulled this right off of Investors Business Daily. It's a daily chart, goes back right a little better than a year, I think. Yeah, it goes back to May, June of last year. And of course, this is what's got everybody's attention is right here. This was back in about mid-August. Everybody remembers a very steep drop in a matter of several days. Just to put a little context, this is last September, October. In percentage terms, not necessarily from the high, but from about right here before when everything started falling apart to down in the bottom here, was about a 10% drop in value. And we kind of look at the S&P because it's a little better indicator than the NASDAQ or, say, the Dow Jones. This drop back here in September and October is also approximately a 10% drop. The difference is this happened over about 25 trading days. This happened in about 4. So the speed and the velocity of it is really was kind of unnerving and got everybody's attention like the end of the world was coming. I will share with you, last time we probably saw that kind of volatility and drops of that magnitude in that shorter period of time was probably in the 2008-2009 cycle. We haven't seen anything like that since then. So why did this happen? Let's just start going through a few concepts. Amber, the next one. This is a chart of the Shanghai Index. All right, China's in the news. Everybody's heard of China, blah, 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 blah. And this is probably the best representation of what's going on in the Chinese market. About a year ago, it was trading around 27, 2800. It got up about sometime in June and July, over 5,000. And then it's down to 3,000. And this is the drop right here that kind of coincides with that drop that we saw in August. And I remember that, and this is like a 25% drop in about a week or so. And that kind of cascaded in the United States. And why would China be a big issue in the United States? One is China has been kind of the engine of growth in the emerging markets around the world. So the concern became, well, if China is falling apart, is global growth falling apart? And that was an issue. Now, I have a theory. I can't document it. I haven't researched it. But we saw some of this in the 2008 sell-off. A lot of large global institutional players, particularly hedge funds, and I'm guessing, okay, so don't quote me on this, but I'm guessing they had exposure over here. And when this thing started falling apart, because remember, it went from around like 5,000 to 3,000 in about 2 months, 2 or 3 months. They operate on a lot of leverage. They operate on a lot of borrowed money. When they work, they really work well. They can take that borrowed money, make huge returns, and the difference between what they're making and what they're having to pay, and they're borrowing money at next to nothing, is a very profitable deal. But when it goes against them, the banks started getting nervous, say, we want some money back. And so sometimes you sell what you can sell. And I know we saw this in 2008, where the institutions were squeezed. And so what do you sell? You sell big liquid U.S. stocks. I'm just speculating that we may have seen some of that started to trigger this thing, that some of these large institutions had to get out of their U.S. positions. Another thing I just learned recently, I was watching an interview on CNBC with a guy named David Tepper, head of Appaloosa Fund Manager, hedge fund, Appaloosa Funds. And David's assertion is that about 30% of the S&P 500 earnings come from emerging markets. Now, I haven't researched that, but David's a very well-known, respected guy, and I seriously doubt he would get on CNBC and make a statement like that unless he had done his homework. And if that's the case, you can understand then why there was some concern about what was going to happen to the S&P 500 and so forth. So a lot of volatility in China triggered this. Now, back up a little bit. The Chinese market is not like ours, okay? It is not a free and open and transparent market as much as ours is. The Chinese government was strongly encouraging participation in their markets. They allowed very low margin requirements. My understanding, they were letting people use as little as a 10% deposit to buy stocks. In other words, you can buy $10,000 worth of stock with $1,000 down and you're borrowing the rest. That's actually what was going on in the 1920s, very low margin deposits. Right now, I believe initial margin deposits are 50% in the United States. So it's a whole different deal on what we do. And they were actively encouraged this, and people were borrowing money from their real estate values to speculate in the stock market. Stories I hear is that China was trying to encourage the growth of the equity markets because the economy has been very, try that again, dependent on debt financing. So they were trying to develop an equity market and encourage that. But like all things, at some point, this became a very speculative bubble. You go almost a doubling in value in less than a year. The last fool's no longer there to buy. The market starts rolling over. You get massive margin calls, and you get this acceleration down. And again, as I suspect, some of our guys got caught in that and had to sell U.S. stocks. And then, of course, the concern about where this market's going to go. So this was really the catalyst for everything here, particularly here. All right, I'm going to put a few things in context. This is something called the VIX. The VIX is a measurement of volatility on the S&P 500, I believe on the futures contracts. We don't have enough time to go into how it's calculated. I've seen the formulas, it's very complicated. But let's just say, for the sake of this illustration, it is simply a measurement of volatility in the market. And this goes back, we date range this back to early 2008. Here's a huge spike in volatility. That's the 2008 sell-off. In October 2007, 50 something, and got as low as, got a little under 700 in March of 09. So in the overall period of this happening, you saw about a 50% decline in value. It's interesting though, by early 09, the volatility was already cutting down even before the market had bottomed out. Now a couple other spikes in volatility. Sometime in the middle of 2010, that was, I think there was a concern about the Fed, whether they were going to continue to supply liquidity. 2011, a nice spike in volatility, and a little bit more in 2012. This was the budget, almost near government shutdown. What you see a couple of spikes here is the European situation, the Greek situation, and then we have this recent spike here in volatility. Okay. Notice, over time, volatility tends to return back to normal levels. In fact, it's been extremely low in here. But after these spikes, the spikes in volatility, they tend to get back to normal. Spikes in volatility also coincide with corrections in the market. Now, this was a huge correction. These were all pretty much in the 10% range. And I heard an interesting assessment, and it's really true, I think. When the markets are anticipating all the time and anticipating maybe a slowdown in the economy, great quote I heard, the market has predicted 18 of the last 6 recessions. Yeah, they think it's going to happen and it doesn't happen. Now, when it does happen, when you do get a recession, that's when you get these massive adjustments downward. But when markets are anticipating either a slowdown in the economy, the Fed, Europe's falling apart, blah, 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 and they start selling off and a recession does not materialize, you get what we'll show you in a few minutes, is a series of 10% pullbacks. So spike, and return to normal, spike, and likely return to normal. Go to the next one. This is the S&P 500 over that same period. It's a little different chart format to stretch it out. So here's that big 08, 09 sell-off, okay? 10, 11, 12. This is last October, November, December, and this recent one. Past performance is no guarantee of future results, right? However, let's just think about when we see these volatility levels settling back down, the markets tend to heal and recover. Nobody out there right now is talking about a recession. We just don't see it on the horizon. And we're actually got something in between here I want to point out, but we're going to talk about a couple of things that we saw in the news that to me tell me we are not slipping into a recession. If we're not slipping into a recession, then this is going to be one of those 10% pullbacks, right here. Like we've had here, here, and here, and here, and here. These happen. We kind of got spoiled because we haven't had that many severe ones. But I think it's a good analysis that we have seen consistently 10% pullbacks that amount to anything because we never had a recession. just want to throw a few things in here real quick. This is kind of interesting. This really relates more to the bond world. This is the fund that owns 20-year treasuries or greater. And just a kind of a little bit of word about bonds. Now, here bonds go up in value when interest rates go down. Bonds, when the government's going to shut down and the euro is going to come apart, and rates come down. Then we've seen, and here is really what I think the Fed was stepping on the gas pedal and flooding the system with money and driving interest rates down and running bond values up. This is the one area that really concerns us is bond values. Okay, the likelihood is that we're gradually going to see a rise in rates. They're about as low as they've ever been, and if rates start rising, we'll see this thing drift back down. Next chart is the actual rate. Okay, this is the 30-year Treasury rate. We're running a little under 3%. A norm would be in the 4 to 5% range. Back up in here, and we're looking like we're trying to get out of here. So my concern is just not the market itself, but on the bond world. If we see rates start getting back up in here, can you go back? Then this has to come down. So just a caution about bonds, all right? And we were really trying to avoid long-term bond exposure. And it's a real frustrating thing because trying to find income, I mean, do you really want to go out 30 years at 2.9%? And that doesn't make a lot of sense. That's why we're trying to look for, on the income side, we're looking for maybe dividend-type yields or even the preferred market or high-yield market or so forth. But 30 years at 2.9%. is not a good idea when you're owning, because that means you're buying an investment that has potential to tumble quite a bit and you're locked into a rate. Okay. And one last thing too about what's been a little frustrating about this market, this is a pie chart that you will often see if you had a mutual, a 401k account or something, and the idea is to be spread out into all these different sectors. And for the last couple of years, what's been really a little misleading is the S&P 500 has done X, okay? And that's this area in the yellow right here. The rest of these areas have really struggled. Emerging markets, international, are in a pretty severe correction over the last year and a half. Small cap rolled over earlier this year. One of the things that had us a little concerned about before the market fell apart was this big downturn is the market was getting what we call narrow, which simply in English means fewer and fewer stocks were part of that upturn. Keep in mind that the major indexes you see on the news tonight, the S&P, the Dow, and the NASDAQ, are dominated by a relatively small number of companies. 60 or 70 companies, between them just some crossover, probably dominate those indexes. Those are the Apples and the GEs and the Exxons, yeah. That's one of the problems. That's actually one of the issues with the S&P 500 as a group. It's merely been weighed down by the energy sector, and we don't have to go into a lot of what's going on in the energy sector as you look at Lafayette, Louisiana. But we did want to point out that diversified portfolios have really been struggling for about a year and a half now, because some of these areas, like last year, the mid caps made a few bucks, the small caps probably broke even, and they actually started trending downward earlier this year. Bonds have bonds have been very difficult to make money in, and international markets have actually down. So we just wanted to point that in context that this has been a tough fight to make some money in this market. Let's get into some good news. This is something we found. Okay, this is a lot of stuff up here. We're going to make this real simple. This is a plot of auto sales, U.S. vehicle sales, cars and light trucks. 4 or 5 years back, nice steady uptrend. These are the monthly numbers. I'll just tell you, you can't see them from there. The best month on here is May of this year. The second best month is July, which is right behind it. The preliminary numbers we're hearing for August are it's going to be the best month in this whole plan. One more little headline I want to put up there. There you go. Home sales approach 8.5-year high, prices surging. All right, I don't have to be a Nobel Prize winning economist to think, okay, if we're getting big, and by the way, that's unit sales, that's not prices on cars, that's the number of vehicles sold in the United States, North America. You're getting home prices up, and you're getting record home sales, and you're getting car sales. Those are the biggest items that 99% of us are involved in. Bill Gates, maybe it's a yacht, okay? But for the rest of us, that's it. And we're hitting record numbers on homes and cars. Okay, we're going to go into a recession. As they said, that don't compute. So despite all the volatility and everything we had in here, and some concerns about the international markets, and they're very legitimate concerns, the United States economy appears to be doing okay, not in a recession. So I think what we saw is just a confluence of events and a lot of volatility all of a sudden accelerating, caused a very sharp panic sell-off. We have not breached that thing, and in fact, I don't know how hard it is to go back to the very first chart. Let's see, it's kind of, okay. I don't know if you guys see this, but we have been, every time we've been selling off in the last 3 or 4 weeks, it is not going as far as the last. In other words, the sell-offs are getting less and less and less, and it's kind of we call this a English rise button. In other words, every time they knock this thing down, they're knocking it down as far as they did last time they knocked it down. And we haven't come anywhere close to those original panic sell-offs about a month ago. And well, from a chart person reader like me perspective, that's a very good sign to see that. Now, tomorrow's another day. But to see that the fact that we're gradually working our way upward, I mean, it's kind of choppy on the upper days, but the bottom days are getting better and better and better. Okay? And of course, everybody's waiting for the Fed. I don't know what the Fed's going to do. I don't think anybody knows what the Fed's going to do, and I don't think anybody knows what the reaction's going to be. So we're not going to try and get in front of that. If they raise rates, and particularly if they come out and make a statement, the economy's strong, the employment numbers are good, we have to start raising rates, that could be a positive catalyst. A lot of people are worried that the Fed's going to raise rates. Really, they're going to go from 0 to 1/4 1%, and that's going to derail the world? Don't think so. Okay, that's just really what we want to put a little perspective. It's really been a kind of a challenging time. It's been a little bit unnerving, but I think if you look at the context of where we've been and have we been through some of these before, and the fact that we just don't see a recession on the horizon at this point, is this will go into the rearview mirror as one of those 10% deals. Okay. Any questions, comments?
How's it
You haven't worked
into all this?
What's that?
How can employment, how does it work into all this? I mean, how terrible it is, and everything just keeps bumping along.
Well, the employment to me is kind of an interesting concept, two-edged or whatever. The official unemployment rate is coming down. They are adding jobs every month to the economy. But wages are still struggling to grow. So and part of the unemployment rate, I'm not so sure recently, but for a while what was happening is, the way that's calculated is how many people don't have a job versus how many do and are looking. And if you give up and say, I'm just going to retire, I'm 58, I'll go cut yards for the rest of my life, then you leave that calculation, and that actually makes the unemployment rate go down. Okay? So let's say you have 5,000 people looking that don't have a job, want a job, and there's 100,000 people that have jobs or looking, whatever. And 10,000, so you have a 5% unemployment rate. 10,000 people just say, I'll never find a job again in my life. Now you're working off a 90,000 base, and you still have 5,000 people look. So that's I went the wrong way. I went the other way. If 4,000 people, 1,000 people give up and say, I don't care, I'm not going to ever look for a job again, I'm done. Now the unemployment rate went to 4% off 100,000 because they gave up. So and there has been some of that happening. Okay. Yeah, I know we're having a good day today. I don't know.
You gotta bring a smile.
Yeah, I don't know. The Fed's going to raise rates 2 days, lower rate. I don't know what they're going to do. But it's a little bit it's a little puzzling, and I agree with you, Steve, that there's some big signals coming out of there. The official numbers say United States employment is growing, and if you back into what we're looking at, something decent has to be happening for home and auto sales to be up there. People don't make those kind of commitments unless there's jobs, unless they're decent jobs, unless they're fairly secure in those jobs. And that's part of the point we're trying to make. I mean, it doesn't compute that look, we're not in a rip-roaring booming economy, and I'm not going to get into policy issues of what would make the economy grow better. But there has to be some things going on for people to be committing to the two largest purchases of their lives. I mean, these are significant.
But wages are stagnant. I mean,
Wages
it's
are
just, it just doesn't fit. You know.
Now, there's some theories out there that the way we're measuring this now is not capturing the current economy. A lot of people work multiple, contract jobs and so forth. There is some, that we're just not truly capturing the growth of the economy anymore because we're using old types of measurements that are in some cases 50 or 60 years old when we were a more industrialized economy and there was more true laborers. A lot of people that, work in consulting, sales, whatever. And I don't know. I'm not a labor economist or an expert on that, but I have been reading some things that there are some challenges out there on capturing the data in a modern economy like ours now, internet exchanges and so forth.
Sure.
So, and I still go back to at the end of the day, home sales and auto sales are a really good reflection of the economy in general because they're such big ticket items. Cars are expensive.
Yeah.
Man,
And gas is already.
I bought and sold a house years ago for less than the last car I bought.
But you get the guy on TV that says, if you raise the interest rates, I'll go broke. And he says, we can't afford to live as it is.
Well, get a job. I don't want to get.
I mean, it just
But
makes.
yeah, that's kind of absurd. And again, a 1/4% raise. When you look at, we had a functioning, flourishing housing market when 6% was considered an outstanding rate on a market, and now they're in the 3s and 4s. Depending on where you are. I bought a house a little over about a year and a half ago. I closed on a house and on a 30-year mortgage, 4.625. And I missed the bottom, by the way, when it was down in the low 4s. And gee, man, I paid a half a point. You start looking into the context of it. That's one of the we probably may never see that skin in our lifetime. But I can remember my mom and dad. We moved here in 1965, and they built their house in '66. And my dad was all excited because he got a mortgage at like 5 3/4. That was one of the best he'd ever seen in his lifetime. So yeah, I think that the economy is quite capable of sustaining an upward move in interest rates. And the Fed is concerned about misallocation, distortions in the economy, about these extremely low rates. And they got their hands full, I will tell you, to withdraw this massive amount of money they created in the last few years. We'll see. I don't want to scare anybody. We may occasionally see spikes in volatility as the Fed tries to start extracting some of this money. Anyway, I don't want to get going too long. Any other questions or any comments or anything? You all going to be back in 2 weeks, or? Okay, good. LSU's going to take Auburn.
Really better.
We'll see about that. I don't know. They didn't look that
You
good
didn't
this
watch
Mississippi.
Auburn.